The Standard Deviations podcast is a weekly production that looks at money, mind, and meaning, all through a psychological lens. Each week, psychologist and New York Times bestselling author Dr. Daniel Crosby interviews a fascinating new guest, experts in everything from finance to literature to wellness.
When was the last time you splurged on something when you knew it probably conflicted with one of your financial goals, like paying down debt or saving for future fun in retirement? Well, if you do this, you're not alone. It's because of present bias, or to use the psychobabble term, hyperbolic discounting. As humans, we have a tendency to let the immediate rewards of the here and now win out over a desired future reality. To learn more, check out the Cash Dash Dash, a planning tool brought to you by the Guardian Network to see just how much your short-term spends might be impacting your longer-term financial goals. Play today by visiting www.livingconfidently.com/play. Hello and welcome to the Standard Deviations podcast. I am your host, Dr. Daniel Crosby. I am joined today by Sean Brown, who is the president and CEO of YCharts. Sean is the proud father of two and husband to one. He is a Notre Dame and Stanford grad. He is a college football and Chicago Cubs fan. And he has a rich and varied career that spans several startups, private equity-backed firms, and public companies. He is passionate in his belief that investors should be able to leverage great investment data and tools anywhere and at any time, and that they should also have access to outstanding human support to ensure their success. Sean, welcome to the show.
Hey, Daniel, thank you for having me. And I do want to say this is the first time I've been on a podcast with a doctor, so I'm a little bit intimidated here.
I hope you are appropriately honored to be here with me today. Okay, so we have to start out by saying you are a Cubs fan, I am a Cardinals fan, and we are a model of civility here today. We're having a really lovely conversation the day after the Cardinals clinched a berth to the NLCS. You were very kind and congratulatory. I would like to think I would have done the same for you, but I can't guarantee that that would have been the case.
My teeth are clenched right now. I am incredibly happy for you, Daniel, and all of the St. Louis Cardinals fan, and I wish you the very, very best.
Well, you are a better person than You're a better person than I am. I think we can both agree that it's one of the best rivalries in sports. Will you be making it to England next year to watch the Cards and the Cubs play in London?
I'm still licking my wounds right now. It's too soon. So please ask me again in 6 months.
Okay. I think we should meet over there. I think we should have a great podcast and then meet over there next year. So I want to start out by telling the listeners a bit about YCharts. So what is it and what makes it such a powerful tool, Sean?
Well, YCharts is a cloud-based investment research and communications platform. So what makes it really, really powerful? We also help investors to make smarter investment decisions. We do that by combining industry's best data with some really easy to use applications, and we surround that with some great human support. So we do all this for about 20% of the price of a Bloomberg terminal and some of the big solutions. So that's what we do. We also help people communicate with their investment teams, with their clients, share ideas through visuals.
So like any good behavioral scientist, I'm very big into trying to distinguish signal from noise. And I've been vocally critical of too much information, more information not always being better information when it comes to making investment decisions. How do you think about what gets through in an era where there's just so much information? How do you think about what's relevant for making investment decisions and what should be sort of left to the side?
Well, I think the point you're touching on is just an enormous one. And I mentioned to you, I'm a substantial portion of the way through your book, The Behavioral Investor. And, you mentioned in there that armed with too much data, inertia sets in and you make no decision rather than a decision or a different decision. And I think one of the big challenges that's out there right now is there are just so many choices. And I'll just pick the simple world of the recently emerging model portfolio world. Models were conceptualized to make investments easier. And the theory is correct. Leverage great thinking in a productized form. The problem we're seeing is there are 10,000 models out there now, and there are innumerable model marketplaces. So, to solve a problem of making things easier, it's gotten more complex. How do I know which marketplace to go to? How do I know which model to select? So the short answer I just gave you the long form. I guess the short answer to your question is different investment theses have different parameters that you would use to narrow down your selection. If you're a growth mindset or you're a momentum mindset, or if you're hey, I just want to talk about FANG sleeves. We help you narrow that down and look at just the right parameters that are relevant to you.
So getting an understanding of your objectives, your goals, your risk tolerance, and what kind of investor you are, then you can provide information that suits that purpose, if I'm hearing you right.
Absolutely correct. I have not seen in my time in my several decades in the market, I have not seen one investment approach that is the only way to go. There are numerous schools of thought, and I think we give you the tools, given your bias or your hypothesis, to pick and screen and filter and evaluate the way you need to and want to.
Yeah, makes sense. And those of you who've read The Behavioral Investor will know that I'm an advocate for looking at a couple of things. First of all, it needs to be data driven, right? There needs to be some evidence in the data that it's empirically sound. It needs to be theoretically sound, because in a day and age when there's so much information, there's so much noise, when you regress enough variables against each other, sure enough, you're going to get some spurious correlation. So it needs to make sort of philosophical sense that a factor or a signal would work. And then I think the third sort of the third black belt level consideration is there a behavioral component to it? Because my bias, again, having a hammer and seeing nails everywhere, my bias is that things that have a behavioral substrate to them tend to endure longer than other sort of non-behavioral considerations, which are more easily arbitraged away. So theory, data, and behavior, I think, are good things to look for in a strategy.
And I love in your book, you use the analogy, I think it's Bangladeshi butter.
Yeah.
Where there's a correlation, but you are missing the theory part. And you also cite the fact that if you have the first two, data and theory, but you're missing the intransigent portion of it, arbitrage takes place that gets rid of the intransigent portion. And so I love the way the framework you propose there. It makes great sense to me.
Let this be a note to all future guests that you better read my book unless you want to get outshone by Sean here. So I read something you posted online recently from a managerial perspective, from a leadership perspective. You said that you like to hire people who are sort of broken, who have a chip on their shoulder or may have experienced failure in the past. Why as a leader, is that the type of person that you seek out?
A couple things. Number one is I think you learn so much more through failure than you do through success. I think one of the perils, and you'd know this as a psychologist, one of the perils of success is people tend to attribute the success wholly to their own force of will and miss the fact that a lot of other factors play into success, including luck. And what I love about people, and I'll be careful to call them losers, what I love about people who have loss as a defining moment in their background is hopefully they took a moment and were very introspective, and they were able not to attribute it all to bad luck. They were able to say, there are some things I could have done better, some things I could have learned. And they demonstrate to me a commitment to learning, a commitment to taking chances and not being afraid to fail, and a commitment to persevering despite the bumps that you may have in the road. So I love chips on the shoulder. I love ex-athletes. I love people that for whatever reason have reached a stage in life where they have a huge fire in their belly about something.
So it's an interesting point you make. If people are successful, I think success definitely leads you to be uncritical. I think most really successful people just attribute that to personal skill, which is a sort of tragedy because you don't learn from it, as you said. But it's interesting when you think about people who've had hard times, people who've experienced failure. I think many of them similarly outsource blame, though. It's like, I know for myself, if something hard comes my way, it's very typical of humankind to say, well, that was due to externalities and not due to my own failings. But if you find someone who has experienced those bumps in the road and then has taken the chance to learn from them instead of blaming, externalities or blaming other people, I think then you've really got someone. So all losers, send your resume to Sean. So no, this is, I love it. We're all a little weird. We're all a little broken. And I love that you see the world that way.
Yep.
Yeah. So now we're going to do what's either going to be the best or the worst exercise in the history of podcasting, which is to talk about charts. So we're going to use an audio medium to convey a visual stimulus. And so, Sean, we're going to ask you to be very descriptive in how you talk about some of these charts. But I asked Sean and his team, and they delivered fully. I asked them to send me just a handful of charts that they felt were most descriptive of the market we find ourselves in today, and they did not let me down. They sent some really great stuff. So I want you to first talk about this chart that's called Performance Following Crises. And so, as a psychologist, again, one of the things that we do that makes us so bad in markets is that we tend to project the present into the future indefinitely, right? We look at what's happened the last little while, and we tend to assume that the future will look just like the recent past. But we know that markets can make us look silly if we make assumptions like that. So talk us through this chart, Performance Following Crises.
You bet. So let me give some quick background here. First of all, something I'll repeat again. Daniel, I know you're going to turn 40 soon enough, right?
Yeah, about 6 days.
Yeah. Do you remember, and you're not going to get any tears from me. I just recently turned 50. So I wish you all the best. I wish your Cardinals all the best, young man. Good. But do you remember the movie Vegas Vacation with Chevy Chase?
I do remember it.
So Chevy walks into a casino, and it's a bizarre casino. They have all kinds of weird games. And one of the games Chevy plays to great comedic effect is guess a number between 1 and 10. And Chevy goes up and puts $20 down, and the guy says, guess a number between 1 and 10. And Chevy Chase says, Clark Griswold, I should say, he says 3. The guy goes, nope, 7. I think of Chevy Chase every time I think of an investment. And I'll talk to you more about that. There are games of chance that make sense, and there are games of chance that don't make a ton of sense. And with the charts that I'm going to talk about, I think one of the themes that runs across it is, in the short run, markets are a lot like puppies. They're chaotic. They wet the floor. They do all kinds of weird things. They bite furniture and they create all kinds of havoc and kind of behave unpredictably. But in the long run, they settle in like a puppy who becomes a great dog. They settle in. They get used to routines and they kind of revert to logical and predictable behavior. So I give that as a preface to say, back in March, there was an Ethiopian airliner crash that really ended up putting a huge dent into the Boeing Corporation that made the airplane the 737 MAX. And we started to think about that at YCharts, and we said, hey, that's a corporate consumer safety crisis. How do consumer safety crises, how does that impact a company's share price? And are there some themes that you will learn from looking at them? So we looked at the 1982 Tylenol tampering. We looked at the Vioxx scare. We looked at I don't know if you remember the Peter Pan salmonella scare. You might remember people driving Toyotas were running into their garages because there was either a floor mat or accelerator problem. There was a Volkswagen scandal, and then there was a Chipotle, E. coli tainted beef kind of thing. A lot of consumer safety related scares. We took a look at those individually and collectively, and we found out some really interesting things about what they mean in the short term and what they mean in the long term as far as the share price of these companies. You want me to walk you through just a couple of those themes?
No, I'd love that.
So looking across these, we saw that it took somewhere between 6 days and 600 days for the incident to create the stock bottom out. But the median was about 31 days. Okay, so let's think, it takes about 1 month for the scare to fully incorporate itself into the share price. And well, how deep did it go? The median share price drop was about 25%. With a range of anywhere between 17 and the high 60s. So significant drop occurred, with a median of 31 days. Okay, so what should an investor know about that? Well, first I ought to throw in my standard caveat. This is not investment advice. These are interesting analyses, all kinds of stuff like that. But what we saw was it took, on average, 13 months for the share price to return to where it was. And, in that 13 months, the average company would outperform the S&P 500 by about 27 percentage points. So a significant outperformance, if you happen to be very good at timing exactly the low point of the dip, on average, you were going to way outperform the market as the share went up over the course of 12 to 14 months.
So here's sort of the definition of contrarian investing, right? You look at these things. I was fascinated to, the Tylenol tampering scandal was a bit before my time, but I was very well aware of it just from B school and things like that. But it took 6 days to bottom out. That seems remarkably short. And it's interesting, though. I wouldn't have guessed that the outperformance was so dramatic, but this is the power of this type of information. And it's interesting, too, there's a great deal of variance between the days between the incident and bottom out. It's anywhere from 6 to 600 days. But there's a great deal of uniformity in terms of the days from incident to price recovery. It seems like the half-life of bad news is about 12 or 13 months, almost across the board. It's very, very fascinating to look at. Very cool stuff.
The other thing, going back to the guess a number between 1 and 10 analogy, is not all companies outperformed, but 2/3 of them did. So we're talking, if you're trying to at least keep pace with the S&P 500, if not outperform, you're playing a Chevy Chase game of guess a number between 1 and 2, 1 and 3, and a much higher odd game than you would otherwise be playing. In fact, you'd be saying guess a number between, with a 66% chance of winning, I should say.
Yeah, absolutely. As you read in The Behavioral Investor, I say, look, no one knows what for sure will happen, but the hallmark of a behavioral investor is that they tilt probability in their favor. And again, without this being specific investment advice, it seems like there's some reason to consider a strategy like that as a potential way to do just that. The next chart you sent, I will not lie to you, it absolutely thrilled me. It's the number one question that I get. No one will be surprised that the name of the chart is Trump tweets. It's the number one. It's the number one question that I get, and I feel like I haven't had a very firm, data-driven response to this. So, something everybody wants to know about. Talk to us about the impact of President Trump's tweets on the companies he tweets about and on the market.
Yeah, we focus specifically. I've got another analysis that we're underway on right now, which is what are the impact of Trump's tweets on corporations if and when he maligns a corporation. And there's a long list of corporations that have been maligned. What happens to their share price? A little bit, a lot, nothing. The one we focused on here was Trump's tweets about tariffs. Twitter, this is the first president where Twitter's really been a communication vehicle. And, we've seen the markets get pretty serious about understanding this. I think JP Morgan just rolled out the Volfefic index, trying to understand it. And Citi has seen a correlation to FX. I think when we looked at some select tweets, and we selected the tweets that were specifically on tariffs and China-related tariffs predominantly, what we saw wasn't real interesting, to be honest with you. It was a very shallow and short impact of that tweet. To be specific, the day after, the average, the market went down almost 0.75 of a percentage point. But 1 week after, it was back up. So is there an opportunity here to do a quick arbitrage when you see certain words in a tweet from the president? Yeah, but you better be quick and you better be first, because a week after a tweet or 1 month after a tweet, we weren't able to decipher a meaningful, lasting impact.
Well, this is what I love about a platform like yours that allows you to make such quick calculations and to look at things in real time. Coming from an academic background where much of the research we did was more, shall we say, cumbersome and lengthy, you would basically not write up a null finding, right? You wouldn't write up and say, look, there's just not much there. The thing that we studied, like there's not a there. But it's interesting to be able to look at something that people presume is such a powerful mover of markets and to say, there's a lot of noise there. It's up, it's down for a bit, then it's up for a bit. And like on average, no big deal. It's cool that you're able to look at that in real time and to be able to make, to publish that sort of null finding. I think that's a powerful thing.
That's what's really fun for me on a personal level, being the head coach at YCharts is, I got the professional layer where there's a lot of stimulation and challenge and things to figure out with growing a company. And that's awesome. But then you go to the personal layer, and I have a nest egg of my own that I manage on my own. And I happen to work for a tool and be the head coach of a company that has a tool that helps me make smart investment decisions. And then when I marry together the personal and professional components, it gets real cool because at night, I'm able to stimulate my curiosity and learning gene with questions like the couple we just talked about. And I will either start the calculation or I'll pull in one of my teammates to say, hey, keep seeing a lot of things about IPOs or tweets or corporate crises. I want to learn about that. I want to develop a perspective about that. And I've just spawned off either a 2-minute exercise or a half a day exercise, but I'm getting answers real quick. And that's pretty fun when you're using your own software to satisfy your own curiosities.
No, that's really fantastic. Now, you mentioned IPOs. I wrote about IPOs in, I believe, The Laws of Wealth. Everybody has an IPO story, right? Because we write these articles, or we don't. We see these articles. If you had invested $10,000 in Apple, you'd have $1 gazillion today, or things, these sort of hypothetical. If you had timed this IPO right, here's what you'd be worth today. Mm-hmm. But no one ever talks about the other side of the coin, and it's interesting because on average, IPOs do about 21% worse than the benchmark at the 3-year mark. So everyone's got sort of a wish I would have invested in it IPO story. But when we look again as behavioral investors about the behavior of IPOs in aggregate, it's not fantastic on average. So take us through this next chart and find us talk us through what you found about recent IPO performance.
Yeah, let me first start with some macro things we found out at looking at 10 years of IPOs, and I think my summary would be IP no, because conclusion number one is only 38% of the major IPOs have shown better returns than the broader market. So, you're playing a less than 50-50 coin game. I remember back in the day when what's now Boston Market was Boston Chicken and they were IPOing. It was like buying into an IPO was a surefire way to make a very decent return. Well, No longer. Over the last 10 years, only 38% of major IPOs have shown a better return than the market. Another conclusion is IPOs have gotten progressively worse at keeping pace with the market. So if I'm saying the aggregate 10 years, only 38 outperformed, the situation's gotten worse and worse and worse over the years, that the median annualized returns, except for 2015 and 2018, they were negative, and they were significantly negative. So that's conclusion number 2. And the spread between a successful IPO and an unsuccessful IPO has also really widened. So you may, if you got lucky, you may make a good chunk of money, but you may make a modest sum of money. But on the downside, and you mentioned this a lot of times in your book, I think you say something like 2.5x human beings take a loss of $1 2.5x harder than they take a gain of $1. Have I understood that correctly?
That's correct.
Okay. So, a fourth conclusion we came to is only healthcare and tech IPOs have outperformed, but they've only outperformed by a slight margin. And then the other one, which is really damning, is IPOs have become more and more and more unprofitable through time. And we drew a line on one chart that showed, back in 2009, of the top 25 IPOs, only 6 of them were unprofitable in the year that they filed. In 2018, that was 15 of the top 25 IPOs that were unprofitable. So when you bring that to 2019, we'll include in the show notes, but all these high-profile IPOs, you've got Uber, Lyft, Slack, Pinterest, Peloton. Thank God you don't have WeWork. The returns, when you look at these, the one-day return on these IPOs, this is supposed to be the celebrating day. My investment banker friend got me in on friends and family for this IPO. Guess what? On average, you're going to lose 11% that first day. And year to date of those IPOs I just mentioned, on average, they've returned almost a negative 9%. So IPOs are not, they are a Clark Griswold game, and I would probably keep my money in my pocket.
Now, fascinating stuff, and I appreciate that macro perspective. At the risk of putting you on the spot, what inferences do you draw about that trajectory? It seems like they're bad and trending worse. Do you ascribe any meaning to that? Do you see any pattern there?
My personal opinion is it feels a lot like the late 1990s, where I think markets lost a little bit of an appreciation for fundamental business models, and liquidity and IPOs became an end game themselves rather than a reward for having a very fundamentally sound financial model, and future trajectory. Like, how many times are you seeing in an IPO filing now, the company does not now have profitability, nor is there any reasonable expectation that it will see profitability in the foreseeable future? Like, that scares the heck out of me to say, yeah, I love my Peloton bike that's in my basement, and my investment is the subscription I pay every month, and I enjoy that, but I am personally not willing to put my hard-earned savings into IPOs where companies have no foreseeable path to profits.
It's right. It's something. It's a refrain you hear on Shark Tank. I'll be a customer, but not an investor, right? Like, so enjoy the bike, but maybe be careful about investing in such hot, trendy stocks, right? So the next chart is everybody's favorite controversial topic. It's about active versus passive management. Now, when I wanted to write about active versus passive management in my books, my editor begged me not to, and he said, look, you're just going to make everyone mad. And I felt like I did that. I feel like I feel like I did a good job because, passive folks think I like active, and active folks think I'm an indexer. So what do you have to say? What does your research tell us about this active versus passive debate?
Yeah, so we did a study because, you teed it up well. What we saw, we looked specifically at large cap blend funds, to contain our focus. And what we saw was that 36% of large cap blend funds that were actively managed outperformed the S&P index over 1 year. So 1 in 3. Look at it over a longer time horizon. That was more like the Clark Griswold guess a number between 1 and 10. Over a 5-year horizon, actively managed funds were about 11.9% of the time they outperformed the index. And it gets worse over a 10-year horizon. It's a little bit less than 9%. Over a real long horizon, which has the survivor whole concept involved in it, actually they outperformed over a 20-year horizon. And one of the lines I circled in your book that I found really funny is you quoted somebody who said, or you may have said this yourself, a really good active fund manager is going to take 25 years to really establish the track record, and just about then they retire. And so I found it funny because I think what it says, and you also astutely point out the fact that there are an awful lot of funds that are positioned as actively managed and charge the 2x fees that a passively managed fund will charge. But there are an awful lot of passively managed funds that are marketed as active. So, the sampling may suggest if you can truly find those active funds that are truly actively managed, that they may outperform. But if you look at those that are actually marketed as active funds, you're better off going with a passive fund.
Well, yeah, it's always been my case. I find this to be the dirtiest little secret in the industry. I got the original research from Wes Gray at Alpha Architect, but they found that somewhere in the neighborhood of 3/4 of funds that are marketed as active management are really just closet benchmarkers. Now, I think there is a place for active management, and I've been a proponent of certain types of active management that are consistent with best behavioral practices. I mean, I go into that in detail in my books. But the thing that makes me angry is when people are charged an active fee for what is effectively a passive vehicle. Like, passive indexing makes a ton of sense, but pay passive prices for it. Active management can also make a ton of sense, but never get caught in the middle for paying high fees for what is really just an index. So it's a fascinating finding there, and it takes some of anyways. I think it takes some of the controversy out of this topic. I think that the two sides maybe have more in common than is sometimes given credit for.
Mm-hmm. Yeah, and I think where truth is going to be fully revealed is it's tough when you look at the last 10 years, right? It's been a rising tide. It's been an absolutely wonderful time in the market. I think the true merits of actively managed funds are or are not going to prove themselves in a extended market downturn. And the alpha that you will see, and we all hope to see from the best, should become imminently clear. But over the last 10 years, it wasn't a real easy period of time to take a look at those that performed well in a recession or downturning market, because that actually didn't exist.
Absolutely. So the next chart you have is a quilt chart. Tell me about what investors can learn from a quilt chart like the one you have teed up there.
Great name for the chart. So for those that aren't familiar with a quilt chart, it basically, think of the columns as years, and the quilt pieces are the asset classes kind of stacked up with the top performing asset classes at the top, and the bottom performing bottom performers are at the bottom. Different colors makes it look like a quilt. I think anytime you look at one of these quilt charts, you're reminded of a very, very important lesson in that you are not going to see the same asset class, whether large cap, bond funds, cash, REITs, fixed income, whatever, emerging markets, whatever you're looking at. I think the thing you'll see when you look at these quilt charts is their colors are spread all over the place, which is a reminder to investors that you need to diversify. What was the tops last year? There's no guarantee it's going to be the tops next year. And in fact, there's very few occasions where we've seen that it is the same asset class. So, we talked about a few minutes ago, passive versus active. There's an argument to be made that, get a passive, inexpensive investment portfolio. You look at a quilt chart and you're going to say, I got to remember that my nest egg needs to be diversified in order for me to manage risks of the future.
Yeah, one look at one of these quilt charts and you see, the different colors dancing up and down over the years. It's a reminder to me of a couple of things. First of all, no one knows anything, right? Like no one knows what's going to do well in any given year. A lot of times it's very counterintuitive. And the only way to really get by is to just own everything, right? I mean, it's no coincidence that I've gone to work for a multi-asset class sort of foundation style company because I believe in that philosophy, right? And so I think that this is really sound advice. We have to be diversified within and between asset classes, not just stocks and bonds, not just domestic stocks and bonds. And so it's a great reminder. My favorite phrase that I stole with proper citation for one of the chapters in the Laws of Wealth was from an article that my friend Dr. Brian Portnoy wrote, which was called "Diversification Means Always Having to Say You're Sorry." Because something in your portfolio will always be underperforming, right? So if something in your portfolio is not underperforming, weirdly, it's a signal that you're not appropriately diversified and you need to do a little better. So I think it's a great reminder.
Dan, you also point out a really, really important concept in your book about not over diversifying. And I know there are different numbers people quote, but you can negate or see diminishing returns, at least the laws of diversification, if you overdo it. So, if you're an all equities person who's trying to diversify your equity sleeve, 15 to 20 stocks is probably the right range that gets you the diversification benefits and the risk mitigation. Going to 30, 40, 50, or moving from 3 or 4 diversified funds to 6 diversified funds, you actually may be hurting yourself.
Well, it's an interesting point, and the most common mistake that I see with diversification is people will present a portfolio to me that say has 10 different large cap mutual funds, and go, look, I'm diversified because I have 10 different funds that effectively mirror the S&P, right? So it means, again, making sure you have that appropriate diversification within asset classes, but knowing that you own all parts of the world, knowing that you own emerging markets, knowing that you own debt, right? Knowing that you own real estate exposure. All of these things are important. I think those quilt charts are a great reminder. So the next chart is called The Best Year to Be Born. I don't see 1979 on here, which was in fact the best year to be born. But talk me through this chart about timing of birth and financial success.
Yeah, and I hate to disagree with you, but I do think 1969 was a slightly better year than 1979. But you and I are definitely not seeing eye to eye on certain things on this discussion.
Musically, I would give you The Summer of Love over Disco Inferno. I would.
Yeah.
You win this round.
Yeah. I think the important point I would want to make is You mentioned 3 criteria for a sound investment strategy, and you mentioned things like write it down and stay disciplined and take emotion out of it. I think one of the things people do need to realize is at the end of the day, luck is still a factor. The 2 charts I'd cite is one chart is if you put if you invested $500 every month starting when you were 25, and you put those $500 into the S&P 500, how quickly would you get to $1 million as let's call $1 million was your retirement goal? I think the thing you'll see, and you pointed it out, is depending on the year you were born, it's going to take you entirely different amounts of time. If you were born in 1951, you would have gotten to your 1 million goal and be out on a beach by the time you were 48. But if you started in 1932, 33, you were going to be 62 before you reached $1 million. And so let me position that in a different way with a different type of chart and say, let's say you put $500 away every month starting when you were 25, and you were committed to working until you were 65. How big would your nest egg be when you hit your 61st birthday and were ready to go fishing? If you were born in 1935, your nest egg would have grown to about $2.7 million. You would have been born fortuitously in just the right years and been able to appreciate, seeing a really predominantly upturned market. Now, however, if you were born in 1944, you were going to see a few nasty recessions, and you were going to see them towards the tail end of your career, which had a huge impact. And so specifically, if you were born in 1944, by the time you reached 65, you would have barely squeaked over $1 million. So back to the point, even the soundest of investment strategies, the right diversification, and the right guidance, we can't dismiss the fact that luck does play a role in how you do in the markets.
So nobody knows, in the moment, whether or not they were born under a bad sign, so to speak, right? No one knows in the moment whether or not they've been born in an auspicious or an inauspicious time. What does the average person do with this information? Like, I'm on board. There's a strong element of luck. Timing matters a lot. Sequence of return risk matters a lot. What practically can the average investor do to be empowered with this information?
I would say the biggest takeaway is make sure you have a good plan, whether you created it yourself or you rely on an investment advisor, which is almost always my advice. Understand the plan and then just stick with it. You can't control when you're born. You have no idea if a recession's coming. You have no idea if there's going to be a Trump tweet about your favorite sleeve holding of FANG stocks. You don't know what corporate crises may emerge. You don't know if there's a whole lot more you don't know than you do know. Have a plan, stick with it. Don't bail when things get shaky. At the end of the day, over long durations, things are going to work out just fine.
I think that's a great point. Another thing it puts me in mind of, I see these articles sometimes about people who have retired early, and sometimes I think that they're confusing the map with the territory, right? So they'll say things in the article like, I've saved X and I retired when I was 35 because the market gets 10% a year and I'm going to draw down 4% a year and then, live happily ever after. The market does about 10% a year on average, but in any given year, it's sometimes down 75%. So, I don't think you can really be too careful in preparing for your financial future. And I think you have to leave a lot of room for ambiguity. We've experienced some wild swings in history, and there's no reason to think that won't persist. human nature being what it is. So I think we need to be careful not to confuse market averages with the reality of the market in any given time frame, your life in particular.
Yep. And the other thing is back to the diversification topic. The appropriate diversification for you is going to change as you age. And a sound investment advisor is going to help you see that your risk profile in your 20s is extremely different than your risk profile in your 50s, which means the tilt towards fixed income and less volatile types of things has to be factored in. And, it's complicated out there, but with the right plan that you're not knee-jerk reacting to, you end up in a good place when you get to be 50, 55, 60. Even St. Louis Cardinals fans end up in a very, very good place.
You couldn't let it go, could you? So, Sean, this has been awesome. You have done the impossible. You've taken this visual medium and you've made it sing on radio. Of course, we will link to all of these charts in the show notes. I'll share them via Twitter and LinkedIn as well. But Sean, as we close out, I always like to try and leave listeners with one sort of actionable piece of advice. So if you wanted to help people become better investors, and just whether it's a book to read, something to consider, an action to take, what's one tidbit that your research has taught you as a step that our listeners can take to just be a little bit better with money?
First of all, investing starts with savings. And my biggest piece of advice would be have a plan to save money, because there is no such thing as an investment plan if you're not saving. So there are great rules of thumb out there about saving as much as you can, but put it in a 401k, try to save 30%. There are some great things to do to make sure you have something to invest. To answer your question though, when you've got something to invest, dollar cost average into the market, read the book, The Behavioral Investor, which will help you really understand that emotion plays a role and you need to control that. I'd also selfishly say you go look at a software package like YCharts and see if that can help you, or your investment advisor can't help you using YCharts to achieve your objectives.
Folks, that is what we call an alley-oop from Daniel. From Daniel to Sean. Sean, hey, thank you so much for being here. If people want to learn more about you or your work, where can they find you or get in touch with you?
So come to our website at ycharts.com, or if you want to follow me on Twitter, Sean_YCharts, and I'd be thrilled to stay in touch. I tend to, my evening musings tend to end up in the form of a picture, and I'd love to share those with more people.
Beautiful. Thank you so much for your time.
Thank you, Daniel. I really appreciate it.
All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by the Guardian Life Insurance Company of America, Guardian, and its affiliates, subsidiaries, employees, and agents, including Park Avenue Securities and the Guardian Network. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information participants consider reliable, and Dr. Crosby and Guardian are not responsible for the consequences of any decisions or actions taken because of the information provided. Guardian copyright is a registered trademark of the Guardian Life Insurance Company of America. All materials are subject to United States copyright laws. Copyright 2020 Guardian. 2020-93892, expiration 02-2022.